If you look carefully at the history of central banks, you'll discover a pattern that has repeated for over a century. When a financial crisis erupts, when the banking system trembles, when confidence in money wavers, who gets saved first? It's not the families who lost their savings. It's not the retirees who watch their pension funds melt away. It's not the workers facing unemployment. It's the banks. This isn't a political criticism. It's a factual observation about how the system was designed to function. The Federal Reserve, like any central bank, has a clear mission: maintain the stability of the financial system. And the financial system, in its essence, is composed of banks, large institutions, and capital markets. You, as an individual, are not the system. You are a participant in the system. And when the system is in danger, policymakers don't hesitate to sacrifice individual participants to save the larger structure. This doesn't happen out of malice or conspiracy. It happens because that's how the system was designed to preserve itself. History is an excellent teacher, and it shows us that those who depend exclusively on the traditional banking system to protect their wealth end up being the most vulnerable when crises arrive. But there is an alternative. There is a way to diversify your assets beyond total dependence on a system that may eventually not put you as a priority. To understand why the Fed will always choose to save the banks before you, we need to look back. In 1907, a liquidity crisis nearly destroyed the American financial system, JP. Morgan, the banker, literally gathered other bankers in his library and forced them to inject capital into failing banks. There was no Fed yet. It was private power, saving private power. The creation of the Federal Reserve in 1913 institutionalized this process. Now, there was an official entity whose function was to be the lender of last resort for banks. During the Great Depression, the Fed failed in its initial mission. Thousands of banks collapsed. Millions of people lost their savings. The economy went into collapse. The lesson that policymakers learned wasn't, let's better protect ordinary depositors. The lesson was, never again will we let the banking system collapse. In 1971, when Nixon took the dollar off the gold standard, the system became even more dependent on confidence. And confidence in financial systems means, above all, confidence in banks. The S&L crisis in the 1,980 seconds cost American taxpayers over $100 billion. Who was saved? The institutions. Who paid the bill? The taxpayers. The 2008 crisis was the clearest example. Bear Stearns was saved through a Fed-facilitated sale. AIG received $180 billion in bailouts. The major banks received trillions through TARP and other programs. Meanwhile, millions of Americans lost their homes, their jobs, their retirement savings. The pattern repeats because the system works this way by design, not by accident. If you understand the incentives, you understand the behavior. The incentives of the modern financial system are clear. The Federal Reserve operates within a framework that prioritizes systemic stability. Systemic stability means keeping the large banks functioning because they are the central nodes through which money flows through the economy. When a large bank fails, it creates shock waves that spread throughout the entire economy. When you, as an individual, face financial difficulties, that doesn't threaten the system as a whole. This is the fundamental difference between being too big to fail and being too small to matter. The principle that governs this is what we can call the hierarchy of systemic protection. At the top are institutions that are considered vital to the functioning of the system. At the base are individuals. This is neither good nor bad. It's simply how the system was structured to preserve itself. But understanding this gives us an important strategic advantage. If we know that the system prioritizes its own preservation above individual protection, we can make investment decisions that take this into account. Diversification, in this context, doesn't just mean dividing your money between different stocks or bonds within the banking system. It means diversifying away from total dependence on a system that may not prioritize you when pressure mounts. Imagine two families during the 2008 crisis Family A kept all their savings in bank CDs, savings accounts, and a 401 retirement fund invested in conventional mutual funds. They believed they were being conservative and safe. Family B kept part of their savings in the banking system, but also owned physical gold, some real estate, commodity investments, and some money in foreign currencies. When the crisis hit, what happened? Family A saw their 401 lose 40% of its value. Their CDs paid real negative rates when adjusted for inflation. They were completely exposed to Fed decisions about interest rates and monetary policies. Family B, on the other hand, saw gold rise from $800 to over $1,900 in the following years. Their real estate, although initially suffering, recovered and benefited from low interest rate policies. Their commodities benefited from monetary expansion. The difference wasn't in how much money each family had initially. The difference was in understanding that depending entirely on a system that might not prioritize them was a concentrated risk. Another example, during the European debt crisis in 2011 to 2012, depositors in Greek and Cypriot banks discovered that their deposits could be confiscated or compulsorily converted into shares of failed banks. Those who had diversified part of their wealth outside the banking system through physical assets, international investments, or alternative stores of value maintained their ability to preserve capital. How does this apply to your personal situation today? If you're an American approaching retirement or already retired, it's likely that most of your wealth is tied to the traditional financial system, bank accounts, CDs, mutual funds, government bonds. This means you're completely exposed to Fed monetary policy decisions, dollar fluctuations, and systemic risks of the banking sector. When the Fed decides to keep interest rates near zero, as it did for over a decade after 2008, who benefits? The banks, who can borrow cheap and lend expensive. Who loses? Savers, who receive real negative returns on their deposits. When the Fed decides to print trillions of dollars, as it did during the pandemic, who benefits? Holders of financial assets, especially stocks and bonds. Who loses? Those holding cash, who see their purchasing power eroded by inflation. The reality is that your personal financial decisions are subordinated to the needs of the larger system. You have no voice in Federal Reserve meetings. You cannot influence banking policies. You are a price taker, not a price maker. But you have an alternative. Diversify part of your wealth into assets that don't depend completely on the health of the American banking system. Diversification outside the system doesn't mean completely abandoning the traditional financial system. It means reducing your total dependence on it. There are several categories of assets that operate with different levels of independence from the conventional banking system. Physical precious metals, like gold and silver, are assets that exist outside the financial system. They don't depend on the solvency of any institution. They are nobody else's liability. For thousands of years, they functioned as stores of value when other systems failed. The key is physical. Gold ETFs and gold accounts still depend on the financial system. Physical gold in your possession or in private vaults offers real independence. Real estate properties offer tangible value and can generate income independent of banking system fluctuations. During periods of monetary expansion, real estate frequently benefits from inflation. Essential natural resources, energy, agriculture, industrial metals maintain value independent of monetary policies. They represent the real economy of production and consumption, not just financial manipulation. Diversifying geographically reduces total dependence on American monetary policy. Other currencies, especially from countries with a track record of fiscal discipline, offer alternatives to the dollar. Bitcoin and some other cryptocurrencies operate independently of the traditional banking system. They offer a way to store value outside the direct control of central banks. Ownership stakes in real businesses, especially those that produce essential goods or services, offer exposure to the real productive economy. The exact proportion of each category depends on your age, risk tolerance, and specific objectives. But the principle remains: don't put all your eggs in the same basket, especially when that basket is controlled by institutions that may not have your interests as a priority. Understanding long-term economic cycles is crucial for timing and allocation of these alternative assets. We are currently in a period of high debt, low interest rates, and significant monetary expansion. Historically, these periods are followed by one of two things: significant inflation or deflation. In both scenarios, assets outside the traditional banking system tend to offer superior protection. During inflationary periods, tangible assets like gold, real estate, and commodities preserve purchasing power better than cash or fixed income securities. During deflationary periods, having debt-free assets independent of financial institutions offers protection against bank failures and credit crises. The exact timing of these cycles is impossible to predict, but their eventual arrival is a logical consequence of current imbalances. The relationship between the Federal Reserve and the banking system isn't a temporary arrangement that can be easily modified. It's the foundation upon which our modern monetary system was built. Understanding this shouldn't generate revolt or despair. It should generate strategic clarity. The system does what it was designed to do: preserve itself. Within this reality, you can make decisions that recognize this structure instead of ignoring it. True financial security never comes from depending totally on any single system, no matter how robust it seems. It comes from intelligent diversification that takes into account the realities of how power and incentives actually work. If you look carefully at history, you'll see that those who prosper through changes in economic cycles aren't necessarily the smartest or the luckiest. They're those who structure their financial lives with a clear understanding of how systems actually operate, not how we'd like them to operate. The Fed will save the banks because that's its function. Your function is to save yourself. And the best way to do that is not to depend exclusively on the goodwill of systems that may have different priorities than yours. This isn't a prediction. It's a logical consequence of incentives and structures that have existed for over a century. The wisdom lies in acting according to this reality, not in waiting for it to change to accommodate our preferences. Because in the end, the only person responsible for protecting your wealth is yourself. And the best protection comes from a clear understanding of how the world actually works.